my mind. Looks like we're in the click.
What is going on, you guys, and welcome back to another video. My name is Brandon. Today I'm joined with my father, Mark, and we have developed a list of our top stocks that we would want to own for 20 years out. And this is actually going to be a fun video. This is not a battle per se, Dad. In fact, it's actually, I'd say, more of a collaboration because we have not told each other what our picks are, and there very well may be overlap. But I think the idea behind this is that we're going to go through a kind of a quick bull case about 5 stocks that we see being good holds in the portfolio, like I said, for a couple decades out. And I think it will just be, it'll be interesting to see what the difference is, where there is overlap. More or less, I mean, that's kind of the topic of today's video. We're going over 5 stocks each that,
Yeah, and we may have some overlap. We don't know what each other have chosen. And the premise that we threw out was, if you could only buy 5 stocks, that was your entire portfolio, and you couldn't trade them for 20 years, what would you pick?
What would it look like?
Right. What would it look like? And sort of the concept really is to see what goes into selecting a company. And I'm going to call it a company, not a stock in this case, because we always look at buying shares of companies rather than individual stocks. And so what are the things that you factor in? Things like, number one, I would suggest is you would want to pick something that you're comfortable will be here in 20 years. Mm-hmm. If you buy something and it's a flash in the pan and 3 years out it's out of business, that wouldn't be very good. Things like, are we true to Canada? We're Canadian investors predominantly, or do we go globally or heavily in the U.S.?
Right.
Things that I would look at are we buying companies that are in sectors or industries that A, are stable, but B, are growing. And I'm curious to see what your picks are, Brandon, because there might be a little difference, a generational difference here, where I might lean more towards industries that I have a high level of comfort and are more proven, whereas you may, as a younger investor, choose more disruptive type industries with a higher potential for growth there. We'll see, where that comes out. Very curious to see what you picked. Things like, are these companies leaders in their industry? I would suggest we should pick companies that have a wide global market reach as opposed to a niche. Again, just because we're holding these for a long, long time, right?
For sure. So, and I think that's exactly right. Coming in with that approach, we can't buy, if the way we're approaching this is you're not going to be able to buy and sell and trade within this period. It's, hey, what's an investment that I can buy and hold for this period through the recessions, through the dips, through the good times, through the bad times, and that all kind of factors into the stocks we picked. But hey, before we dive in, guys, I will ask everyone watching to quickly drop a thumbs up. As well, leave a comment down below. First of all, with the stocks that we pick, whether you like them or not, whether you're with them or against them, but also if you had to pick 5 stocks, what would they be? And there may again be some overlap, maybe stocks that we never even considered, but do leave that down below. As always, we do have our Academy down below too, if you want to check that out. But again, we've talked for a long time. Let's dive into this, Dad. And why don't I take things off? Let me just take the screen here. We'll get you back up in a moment. But my first pick is one that I've covered on the channel so many times, but it was a clear first pick for me. It's the company Brookfield Asset Management. So the ticker for this one is BAM.A.TO. It trades for about $75 Canadian. So it's listed on both the Canadian and US market. Question for you, Dad, was this one of your stocks or am I clear to go?
Clear to go. Brookfield was on my short list, but I didn't select it in the end yet.
Beautiful. Well, I got nothing but confidence in this company over the long term. Looking back over the performance, as you mentioned, it's important to know, how is the stock going to perform over long periods? And you do have the drawdowns nonetheless during the major recessions like 2008. This company is, of course, tied to the finance sector. They're tied to real estate, which, like many other companies, no one's really exempt from these times. The companies do draw down, but they have come out stronger each and every period. And Brookfield Asset Management, just to read here their overview for those who are not familiar, is a leading global alternative asset manager with over $625 billion in assets under management across real estate, infrastructure, renewables, renewable power, private equity, and credit. Our objective is to generate attractive long-term risk-adjusted returns for the benefit of our clients and shareholders. Brookfield Asset Management is, of course, the parent company of various divisions, but a chart that I want to look back to look at some historical returns. This one dates back to 1995, so we're looking at about a 25 year period. Share price increase of over $2,000 during the past couple of decades. The dividend itself, although not a large one, has grown by 655%. This got you an annual return over this period of 2,691%. And important here, the annualized average return of 13.23 over this period. Now, when you compare that up to the TSX, which we know kind of ranges in that 5, 6, 7% range, slightly lower than the S&P, this is significant outperformance over that period, and I would anticipate that going forward. I've talked about this before, but Brookfield has one of the best management teams out there in terms of the transparency that they have with shareholders. They do quarterly letters, basically in as simple terms as they can get it, to let you know what's happening within the company. That includes the good. That also includes what struggles they're facing. I have a lot of trust in the CEO, Bruce Flatt, which you need to do if you're going to be investing in a company over long periods. And one thing that's important is that this company has a very long-term vision in mind. It's a company that I expect would leverage their size and that massive AUM number that we talked about. They can continue to scale that on a global level. And of course, this company is headquartered in Toronto, so we are looking at a Canadian investment, but they do have investments all over the world. And this map that you're looking at is taken from 2020, so the numbers have grown since then. But most importantly, a statistic that I think is huge for this company is the alternative asset space is a rapidly growing field of investment. This is a study done by Wills Tower Watson Global Pension Asset Studies. It is back in 2020, but it's a very, very clear picture that they're painting that alternative assets is the place you want to be over the coming decade and beyond. So in my opinion, Brookfield is just perfectly positioned to capitalize on this. It's a stock that I would consider a core position in my portfolio. It gives you that Canadian exposure, but also the global presence. I would be happy holding this stock for 20 years and beyond, but that's actually my first pick for today's video. Any thoughts on that one?
Oh, I love it. Like I say, BAM was on my short list. And for all the reasons you mentioned, and I like most specifically, I like the diversification. So there's lots of streams, different lines of revenue. So they'll be able to sort of mitigate any ups and downs in the market. And the bent towards the alternatives. That's
when very you look big in the coming years.
Yeah, when you look at themes that are going to be forming or have formed, really important when you're looking 20 years out. So no, I think Brookfield Asset Management is a great choice to have on our list.
Thank you, Dad. Well, I'll give you the screen here, and have at it with your first pick.
Okay. Well, my first pick is Amazon. And I'm curious, Brandon, being a younger investor and Amazon being relatively a younger company, is that one of the ones that was on your list, or?
No, I mean, it did make my short list as well, but believe it or not, I actually left Amazon off the list, and I can kind of explain why with one of my later picks, but go on.
Sure, sounds good. That'll be interesting to hear. So I did choose Amazon, and when you look at what makes up the economy, obviously retail is such a huge part of that, and Amazon I sort of look at as a couple of different companies. I look at them as obviously the retailer with their online presence in both North American or U.S. based and internationally. But also, of course, for those of you who are familiar, Amazon has the AWS, or the Amazon Web Services, and that makes up right now about just over a quarter of their business overall. That is going to continue growing as we go out. When I look at Amazon, I'll throw up a chart here that shows the various streams of revenue. Online stores, as I mentioned, AWS. Third-party selling services, as we know, is a big part of that. They have physical stores now, of course, with Whole Foods. They have some bookstores, etc. Subscription services, and then about $17 billion in what they classify as other, and it's ad revenue, co-branded credit cards, that type of thing. When we look at one of the big reasons I really love Amazon, aside from the growing and just how innovative the company has been, and this was a disruptor, obviously, is the attention that they're paying right now to the cloud storage. And they are the world leader right now with about 32% of the global cloud storage. Microsoft is second with around 19-20%, then Google Cloud, and then it just goes down from there. This is a service that is on, as this next chart shows here, a steady growth path. As things get more and more digitized, there's just no question that the future of Amazon or of the sector of Amazon is just going to continue growing. Mm-hmm. When we look specifically at e-commerce, which is obviously a growing sector, growing industry, Amazon blows away the nearest competition. Interestingly, the second place in e-commerce is Walmart today, ahead of eBay, Apple, etc. But they disrupted, they created the space essentially, and they're miles ahead. And I believe that they'll continue to grow over the next 20 years. And if we look back over the decades or the decade or so, what we see is the innovation in what they've done. So obviously, everybody knows they started as a bookseller out of the garage, and they've just, as new opportunities have come up, they've been able to innovate and create those new lines of revenue as well. I like the innovation nature of the company, so I don't see that slowing down in 20 years. It's a long time, but it's also a short time in the big scheme of things. If we look back at their revenues, clearly it's just the last few years that they've become profitable. They're kind of famous for, in their early years, just putting most of their revenues back into building the business, and now they're at a position where they're pulling in $386 billion of revenue every year, and that's obviously just a massive number. From a net income perspective, you can just see sort of the large increase in the last 5 years or so. So I see this as being a company that certainly will be around in 20 years. And when I look at it from a portfolio perspective, again, the importance, we always are buying things. And interestingly, during the COVID-19 pandemic, that didn't stop. I mean, for a brief period of time, but people just leaned onto companies like Amazon to provide that service. So I see this as a long runway ahead of it, and I'm comfortable picking Amazon as one of the companies in our portfolio. What are your thoughts on Amazon, Brandon?
I love that pick. Like I said, it didn't make my list, but especially the point you mentioned there where, they started as a bookseller and look where they've gone to today. Yeah. 20 years from now, who knows what's in store, right? But with the proven innovation and the proven leadership, it's a company that you can somewhat put your faith in that, the possibilities are endless with what's coming in the future. So I really like that pick.
Cool. Good.
Well, let's jump into mine, and it's not as exciting as Amazon, but hey, it makes my list. It's the company TD Bank, ticker TD.TO. Another Canadian pick for you guys, so I'm starting off with two Canadian ones. This one trades at just under $90 Canadian at the given point, and this is, of course, one of the highest rated banks out there. In fact, the slide that you're looking at shows within the Canadian market and the North American market. But with the Canadian market, they rank number one in many key areas. AUM, deposits, market cap, they are just shy of RBC. It doesn't show here cards outstanding, but that's a very profitable area for banks, obviously. But this is just straight up a leading bank, as we know in Canada. But even on a North American level, they still have very impressive numbers against some very, very high-profile U.S. banks. And that's really impressive when you think about how established some of these other institutions are, like south of the border I'm talking about. But this is a stock that although a lot of people will say, it's boring, it's not going to give me any growth. It sure does give you growth. Even for a younger person like myself, you got the growth aspect, you got the dividend aspect. Just to take a look back over this, time period, these shares all time are up well over 3,000%, 3,468%. And really at the end of the day, our Canadian economy relies on the banks. It is such a crucial part of what we do here in Canada. Everything we do runs through the banks. Even during a major crisis, this is one thing that I think is really critical about this presentation today, Dad, is that if we look back at things like the financial crisis, I came across a few articles which I can share with you guys. It says, why didn't Canada have a banking crisis? Or why was Canada exempt from the financial crisis? And don't get me wrong, no one was truly exempt from the financial crisis looking back. But compared to a lot of the banks down south, the Canadian banks actually did so much better, and they withstood that crisis so much more. In fact, it says here, not a single major Canadian bank financial institution failed, while we had bankruptcies and failures all across the world. And to me, it just goes to show that Canada, the financial system in Canada, really is kind of like this pillar of resilience, is really a way that I would put it. They're very well regulated. Nowadays, you have all the stress tests, which I know are kind of annoying for consumers, but from a business standpoint, they've got the procedures in place to thrive for the longevity long term. So to me, this is just an all-encompassing bank. Obviously, you got all aspects from banking and lending, investment management, self-directed investing, insurance, you name it. What I do like about this is they do have exposure to the U.S. So although a Canadian bank, when you factor in the population of the U.S., which is I believe today, as of the numbers I got, about 333 million in comparison to Canada's of about 38 million. It makes sense to have a portion of your business down there, and you get that diversity on a geographical level. I believe they have about over 1,000 locations down south, and their earnings, about 30%, are driven from their U.S. retail division. So obviously this stock for me is a clear cut. It was one of the first stocks that I felt comfortable adding to my portfolio. And if you're a new investor and you're thinking about a stock to own, you can always fall back on the banks, in my opinion. Last but not least, I'll mention you do, of course, get an amazing dividend. Currently sitting at about 3.5%. This is a dividend that's grown tremendously over the past 20 years. Currently paying $3.11 per year, close to double-digit growth rates. Again, this is a no-brainer for me, and TD Bank would be my pick for, I guess, stock number 2 here.
Totally on board with TD, Brandon. I don't believe that you can go wrong with banking in general. I mean, finance or financials is the world's largest sector when it comes to largest industry.
It's everything, yeah.
I mean, we can't function without it. And I agree with you that even if you look at the J.P. Morgans of the world and all of the huge Asian financial institutions, I like what we have here in Canada for a lot of the reasons that you just
don't take it for
articulated.
granted. Yeah, don't take it for granted.
Well, I remember being so proud. Our nation was so proud when we hit the credit crisis, and the Canadian banks were kind of the stellar performers during that time. So I think that TD would be a great candidate for, I don't know how many different companies we're going to have today, but for 5, I think Canadian Bank TD would be one of them in there.
Awesome.
Interesting. I noticed how you've picked 2 Canadian companies to start
just
things off.
Get them out of the way. Get the Canadian ones out of the way. That's the way I look at it.
It's interesting because I think latest count, Canada is like 2.5 or 3% of the world economy, and so you would expect that out of 5 or possibly 10 stocks with us, that you would have maybe 0 Canadians in there. But it's
fair
good
thought.
It's good
fair
to see
thought,
that
but
there. Good.
Fair thought.
So my next pick, going in the concept here again, I cannot sell this company for 20 years, and I want to be able to sleep at night, is Johnson & Johnson, so J&J. And J&J is another American company. It trades at about $164 US currently, and it has a market cap of about $432 billion. When I looked at what sectors, what industries do we need to be in for a portfolio like this? Well, healthcare jumps right out to the top. Obviously, as the world's growing, we're an aging population, and so healthcare is right at the top with financials in there. Now, I thought, okay, do we go with a big pharmaceutical company? Do we go with a company like CVS or like an insurance type company? I decided on Johnson & Johnson in this category because it does have the exposure to both the pharmaceuticals. It has exposure to the consumer health space. It also has medical devices. So there's a whole range of that medical field that Johnson & Johnson covers off. So if you look at their revenues, about $45 billion comes from their worldwide pharmaceutical sales. Another $23 billion is from worldwide medical device sales. That's something that a lot of people don't even think about when you think of a company like J&J. And then another $14 billion in consumer health sales, like the Tylenols, Listerines, Band-Aids, all of these brand names that we just see every day, but sort of take for granted and don't really think of where they're manufactured. J&J has 28 platforms or products today with over $1 billion in annual sales. So each of these independent of the other, whether it's a product or whether it is a vaccine, for example, 28 products with over $1 billion, and that's pretty phenomenal. I mentioned at the outset, one of the things I certainly considered was globally, what is the reach? It's a big place out there, and you just said, Canada 38 million roughly, the US 380, somewhere in that range, and then that's just, even that is a small chunk of the world in general. So when I look at a company like J&J and where they do business, you can see by this next chart here that they have the bulk of their money, 43 billion dollars rather, comes from the US. They have a big chunk coming from Europe, the Western Hemisphere, excluding the US, and the Asia Pacific Africa area. And from a distribution area, they have, in their segmentation, they have the biggest chunk, as I mentioned, 45 coming from pharmaceutical. They have medical devices and consumer health. when I look at a company and say what's going to go, what do we look at going forward? Of course, we can't 100% rely on what's happened in the past. But when you look at a company like J&J, which has been around seemingly forever, they've obviously proven themselves. And you look at their revenue growth over the last 20 years and their net income, they did have obviously a big hiccup back in 2018. For the most part, they have very reliable revenues that I think you can count on there to provide you with your money coming in. We're looking at 20 years going out. AAA credit, one of two companies, I believe Microsoft and Johnson & Johnson are one of two companies that have a AAA credit rating. Again, coming down to stability, that's important in my eyes. 59-year track record of paying a dividend tells you sort of the focus on the company through all of the crises we've seen during that time. They've really made a point of maintaining that dividend. I will say, one of the things that has nagged me with J&J for the last number of years are their legal issues. And because of the nature of the business they're in, and they do have some significant headwinds on the legal issues. Now, clearly, if I felt that this would be a majorly disruptive issue in the company, I wouldn't pick them for the next 20 years. When we look at the history of large corporations being sued by individuals or groups, generally speaking, they work their way through those, and J&J certainly has cash flow. They certainly have the purchasing or the power to manage through these. But it is a flag that I am aware of. But factoring everything else in, I still decided that because of all of the strengths of the company in the medical field, it's a company I had to add to the portfolio. So my second pick, I guess, today, to go along with yours, Brandon, would be Johnson & Johnson.
Yeah, they got the big lawyer teams. They'll just sweep everything under the rug, right?
Well, I mean, they'll certainly fight it. And one of the things that always happens, you hear the headlines on these where a company, a plaintiff is awarded $1 billion or $5 billion. At the end of the day, those are virtually always, slashed by 90%, 95%, or even smaller, or just on appeal, just thrown out altogether. Now, I don't play. I'm in the middle here. If a company deserves to be sued, sue them. And if a plaintiff has been harmed, they should be compensated for that. But I find it hard to understand how a person would have $1 billion award. But so it's normally those big awards are sort of scaled back. So I'm comfortable with that part of the business.
That's fair. And yeah, Johnson & Johnson was not on my list. I think a little slow for my liking, but hey, I totally respect that. Because why don't I jump into mine now, which is definitely my highest risk reward play on this list. And I think this will definitely not make your short list. Okay. But it's the company Tencent Holdings, ticker TCEHY. I think you knew this one was coming up at some point, Dad. It's trading today.
Yeah.
It's trading today at $64 USD. And on this chart that you're looking at, it does show the market cap in Hong Kong dollars, in Chinese currency. If we were to convert that over to US, however, this is about a $600 billion company at today's levels. And this makes it actually the 9th most valuable company in the world. Now, in my opinion, do not be surprised when this company one day breaches that $1 trillion mark. Like some of the ones we've seen here, to me, this is an inevitability. Obviously, it comes with its risks, but I do see that being a very, very clear path for the future. But Tencent, for those that are not familiar, this is obviously a major Chinese tech conglomerate run by Pony Ma, one of the big businessmen over in China. Massive social networking company with instant messaging, WeChat, etc. Also huge in the video gaming field. And this stock has been volatile as of late. I got a lot of people leaving mean comments and whatnot. Of course, with China cracking down and even cracking down on the video game sector in particular, especially the tech sector, I should say. But you look at the numbers, and here, for example, is their 10-year average return. It sits at 31% compounded, okay? If you take a look at the financials of this company, they're just too attractive for me to pass up on. And this is really across all major metrics. The only thing that I believe really holds this stock back is this regulatory issue, is the geopolitical issues that will always be present. And that's something that you do have to factor in when you're investing in these markets. But I've done so many videos on the channel, actually recently, within the past month or two, if you want to go search those up, just giving my overall thoughts on the Chinese market and how I believe despite the worries and despite the threats and despite all the oh my God, despite all the panic that we are seeing here, I truly do believe China will at one point be the strongest economy out there. It will continue to grow. The data does suggest that. And some of these tech giants, I think, will go on to be some of the biggest companies in the world. They already are at the ninth largest, but I think there's still room to grow. This is a stock that I've personally owned since about 2016, 2017. And even in that short period of holding for about 3-4 years, I've gone through some pretty big swings with this. So it is going to be a volatile stock. It's one that I think you kind of have to close your eyes, and it actually kind of works well with our 20-year time frame where we don't consider panicking. We don't consider selling out when things get rough, but just say, hey, 20 years out, where do we see this company? Let's fast forward there. Is it going to be much bigger than it is today? I truly, truly believe it is. So that's the company Tencent for me as well. Again, one of my biggest bets in my portfolio. That's the ticker TCEHY.
I suspected Tencent would be in there, but I wondered because of the time frame. So what you just said is very interesting. The 20-year time frame could hurt a company like this, or it could help a company like this. And you're obviously more leaning towards all the ups and downs, but at the end of the day, it'll do just fine. And so let things ride out.
I'd encourage the viewers to watch my previous video. I did a video basically talking about all of these regulatory changes that are happening with China and how they're being painted as a terrible thing for companies and they're trying to crush these companies. I actually take a very, very polarizing view in that they're actually making it a better runway for the long term, although it will have short-term impacts.
Yeah, and I think we agree. It's funny, you and I did a video specifically about some of the differences that we have, and Tencent was, I think, one of the stars of that show because my big concern, and going back to the 20-year time frame, is if I sit here today, will Tencent be around in 20 years from today? Probably. But am I willing to take 20% of my investment portfolio and put it in there? I would say no. Just
too much
strictly from that reason.
Risk. Yep,
it's
that's fair.
We've talked about this forever, Brandon. That'll be a home run or a strikeout, kind of one of the two. And right now, in something like this, I'm looking more for the odd double or maybe a triple, but I'm not swinging for the fence with any of the companies that I'm going to put my financial security on for the next 20 years. But we'll see on that one. And from a company, from what they're doing, crazy good company. Just the insecurity would trouble me a little bit. But with that, I'm going to move into my third pick for today, and I'm leaving the U.S. and I'm going overseas to Switzerland. So based on that, you can probably guess what I'm going to select. Now, when I think of what are we going to do for the next 20 years, we're all going to eat. That's something that people are going to do. So I looked to the food industry, and I just said, if I had to pick something from the food industry, which I think we should do in a company, in a evaluation like this, pick food, and I picked Nestle. So Nestle is the world's largest food company, trading right now on the it does trade in the U.S. market as well as an ADR, trading at about $127 US per share. Market cap of this company at $348 billion. You hear a lot when you're talking about investing is buy the things that you know, buy the things that you consume. And, right from when you were little, that's kind of one of the investing tenets that we preach. And when you look at the brand chart of a company like Nestle, everybody across the globe practically has a Nestle product or two or more in their house, right from babies all the way up. I do like how they have a broad array of products from the stuff that's bad for you, like the Haagen-Dazs ice cream, but in moderation, I guess it's fine, right through to the healthcare for older people with the healthcare nutrition division that they have. From a geographical perspective, their sales come mostly from the Americas, about $37 billion. Second to that, they have their Europe, Middle East, North African division with about $24.5 billion, and about $22 billion coming from the Asia, Oceania, and the Sub-Saharan Africa. I always have trouble saying that, coming in at about $22 billion. They sell in about 186 different countries around the world. When you look at the way their business is broken up, they've got largest division is powdered and liquid beverages. They have pet care. They have nutrition. They have prepared dishes, of course. I mean, everybody will have those in their home. Everybody loves their milk products and their ice cream, confectionery, and water as well. Their revenues, when we have a look back over the last 20 years, have been not amazingly growing. This isn't I'm going to shoot the lights out like a possible Tencent. This is more of a slow and steady wins the race. Very reliable, very dependable. When you look at this sector, the consumer staples sector, specifically in food, with Nestle's diverse product line, and an emphasis that they have now on expanding their healthy meals. And so I think every company has to adapt. I mentioned that earlier. And when we think of Nestle, we don't necessarily think of the healthiest foods, but they sell a lot of them regardless. And they are expanding as the world changes, as people evolve. They're coming in and they're looking to expand in the health line as well. And like I say, big in the pet foods division as well. So I think for all those reasons, Nestle is a company. If you believe that we should have some company that focuses on the production and distribution of food, Nestle would be my pick. Although there's a million different ones out there, and this was a kind of a tough industry to narrow it down. But having to pick one, I picked Nestle. What are your thoughts on that, Brennan?
I like it. It wasn't on my list, and it wasn't even actually a consideration of mine. I think Nestle just kind of gets put. It's off a lot of people's radars because you said they are based overseas, and a lot of people don't even know you can invest in Nestle without going to the overseas market. But with the ADR, it makes it very, very possible. And I've considered adding it to my own portfolio back in the day. I never ended up pulling the trigger. But yeah, I don't think you can argue with Nestle. I think it's awesome. I love the snacks.
Possibly boring, but I want a mixture in this portfolio. 20 years, 5 companies. I want a mixture of boring and something a little bit more exciting as well.
Okay. Before we move on to my next pick, guys, I do have a quick word from actually the sponsor of today's video, and it's the company Passive. I've spoken about Passive before on the channel, but they are a partner, and Passive is basically a portfolio management tool that helps you maintain a balanced portfolio, and you can track your performance. All you have to do is connect your brokerage account. It's super simple. You can even do crypto, and you can set these target allocations, kind of like an asset allocation mix that you're aiming for, and you can even follow those and calculate trades within the app. Passive is a free tool to use, but you can upgrade to a Passive Elite account if you do want access like one-click trades and whatnot, versus logging into your broker. You can do that all within the platform. If you are a Canadian, you can actually get Passive Elite for free if you have a brokerage account with Questrade. They've partnered up with them, and because we do have a good relationship here, I've negotiated a pretty special deal for all of my US viewers, which I know we don't have as many, but they can get access to Passive Elite for 1 year if you sign up using the link down below. Thank you to Passive for sponsoring today's video. But let's move on into my fourth pick for today, Dad. This is one that I feel we may have overlap.
Okay.
You know, we kind of have some here. It's the company Disney, ticker DIS, trades for $172 a share. Is that one of yours?
It is not. It is not
Wow,
one of my companies.
That's insane. So not a single overlap this far away. I like it.
So far, yeah.
But I know Disney is obviously not our most exciting tech company. It's not an Apple or an Amazon. But to me, it's the intangibles with the company Disney that make it so unique. And of course, they are techie now. You got the streaming, and that's exciting. But I don't think we should overlook what really Disney is. I guess they're not founded on this, but to me, when I think of Disney, I think to the resorts, I think to the parks, I think to Disneyland, Disney World. I want to go to one in Tokyo in Japan. There's something about theme parks that I think, and this may be a hot take, but I think they may actually get more popular with time. You know, Dad, like everyone is trying to stay home with COVID, and everyone wants to, you know, go more digital and whatnot. And that's definitely been a trend we've been seeing over the past decade. But I think down the road, whether that's 20 years from now or 10 years from now, I think people are going to actually lean back towards these experiences. You know, you got your family, you got your relationship, a couple, when you want to go travel. It's like, you know, those memories that you get from actually going to a place like Disney World or Disneyland, there's something special about that. And there's only so many options across the globe where you can go to a huge theme park like that. That's what I mean by those intangibles. Of course, Disney has this massive catalog of characters and movies that's going to provide them with content generation for years and years and years to come. Shang-Chi, you know Shang-Chi, Dad? I just watched that new Chinese movie. Did you watch that one? I bet you didn't watch that one.
I did not.
You probably don't even know what Shang-Chi is.
It sounds like something you might eat at a Chinese restaurant.
So this was an awesome movie. I'd actually encourage you, if you and Jenny want to go watch it, it was amazing. I came in with low expectations. I would watch it again. It was so good. But this was, of course, one of their new movies. It grossed, I think, it topped $400 million in box office sales during a pandemic, all right? People are still not comfortable going out to movie theaters, but that's just massive. They have countless movies coming up, and one that kind of sticks out to me that I saw is like Little Mermaid, right? The Little Mermaid remake. So they can just basically look at these old movies that were made decades ago and just make new and revised versions. And of course, Disney Plus is obviously going to be big for them. Looking at the numbers, we already know over 100 million subscribers. And if you look at the growth over the past few quarters, we've seen that climb and climb and climb. Maybe COVID has played a role in that. Nevertheless, if you have a family, if you're somebody with children, kids under like the age of 10 or 12 or whatever it is, you're probably going to have Disney Plus. Like, I don't have Disney Plus, but I could see a lot of people having that. And there's obviously going to be more and more kids, and they grow up and there's a new batch of kids. It's just an endless cycle of an audience that they can monetize and target. So to me, I think it's just a clear one. Obviously, they did cut their dividend during the pandemic, and that's something that I think a lot of investors are sad about. But over the next 20 years, over the next 2 decades, I anticipate that at some point when we get through this pandemic, when they start generating more revenue from their parks and whatnot, it gets back to more of a normal type of life. Even though we're getting close to there now, I anticipate that dividend will come back. So at the end of the day, this is a company that we all love. I think it's a very clear one that we can include in the portfolio. And for me, I think it's important to invest in companies that you get behind. And that's why I know some people don't like Tencent. I like Tencent. I like video games. I like what they do. Obviously, they have their downfalls, but you kind of resonate with certain companies, and Disney's one that I think everyone can resonate with. But yeah, that's my 4th pick.
Surprisingly, Brandon, I didn't have Disney on my radar.
Yeah.
When you go through what you just said there, I mean, Disney is one of my favorite company. I own Disney. I just didn't think of it as a company from this perspective here. What I'm going to do is I'm going to send you, Brandon, for when you put this video together to put up on YouTube, a picture of you at Disneyland. And,
there you go.
Hopefully
That'll be beautiful.
A real treat for our viewers. Will put that on there. And certainly, I mean, as a father who raised two boys, Disney was a huge part of our lives during those times. And what I do like about Disney a lot is the fact that they're not just catered to the younger crowd. I mean, Disney has a massive catalog. We think of them as I think of them as Dumbo and or Bambi and those types of movies, right? But they have this massive catalog for all ages, and they're
Marvel.
They're massive.
They do sports, like people
ESPN,
don't think about that. Exactly.
So now that they, when you think past, like you said, they resonate with you with the theme parks, and there's some great memories that a lot of children and families have from.
Not even children. I'm 26 years old. I want to go to Disneyland. I'd go to Disneyland right now. Like it's a great time. I really do enjoy it. I mean, maybe as like a little bit older, I'll phase off that, but I still do, and I think I always will.
I just thought of this because you mentioned them making through the pandemic, doing the dividend cut, but they've survived the pandemic and coming back strong. If I'm not mistaken, I can check the timestamps on it, but I believe the last time that we were at Disneyland was a week or so after the 9/11 attacks. Yeah, and wow. Disneyland was empty because everybody was fearing further attacks, and so we were there very shortly thereafter, and it was great because there were virtually no lineups. Of course, you and Jesse didn't care; you just wanted to go and get on the rides, and so I think
But great lesson that those do fade with time, right?
They do fade, and they'll go through cyclical. So I love Disney, so it's a great pick. I would definitely,
awesome.
if we had shared our thoughts ahead of time, I would have been an advocate for sure. So yeah.
Okay, all you here.
I'm going to go on to my 4th pick, and so far we haven't overlapped, but this is going to be as close to an overlap as humanly possible without actually overlapping. My 4th pick, coming right here to Canada, was Royal Bank, or is Royal Bank. And so I'm not going to go too deep into the reasons, because so many of them, Brandon, are exactly the same as what you talked about with TD Bank. I've often thought that if you're picking a Canadian bank and you're picking, you're trying to decide, flip a coin. If it's TD or Royal Bank, you could almost flip a coin. And certainly over the next 20 years, I would say, regardless of where they're valued today, I would say you'd be fine with either of them. So Royal Bank, just a quick review here. It is Canada's, from a market cap perspective, Canada's largest bank, trading at around $132 Canadian, market cap of about $188 billion. So as you alluded to, Brandon, just slightly ahead of TD, but they're really neck and neck for all intents and purposes. In addition, and you did touch on this with TD's exposure to the U.S., Royal Bank is one of the 10 largest global banks by market capitalization, and people might not realize this, but they operate in 29 different countries, with about 17 million clients across the globe.
Jeez.
I know you watch basketball, and I'm watching a lot of baseball, and I'm amazed at how often during a sporting event they'll show the background or they'll cut to a commercial, and you see either TD or RBC on those, and so they're the huge presence. I remember being in New York a few years ago, and I was just stunned at how many branches of TD Bank there are on the streets that you'll see there. From a diversification standpoint, I mentioned this earlier. They have 5 sort of major sectors or segments that they operate in: personal, commercial banking. They have capital markets, wealth management, insurance, and then investor and treasury services, which is the smaller of them there. From a geographical perspective, we just talked on this, about 60% almost of their revenue comes from Canadian operations, but fully a quarter, 26%, comes from the US markets, and 16 beyond that. I was also going to talk about, and I think we may have even referenced one of the same articles, an article I had here, why Canada didn't have a banking crisis back in 2008.
That's funny.
I just put up one of their, we can put up on the screen here, one of their charts of, they call it prudent risk management. But when you look at things like the quality of their loans, or the impaired loans ratios that they have to keep up, when you look at their provision for credit losses ratios on impaired loans, and you look at how strong those numbers are, it gives me a lot of comfort. From a revenue perspective, I mean, just what you'd want, just growing revenues, growing net income, very, very well managed company. They do pay, as TD does, a strong dividend as well. And importantly, in this era that we're living in, they are placing a high emphasis on building out their digital platforms. I can't remember the last time I was actually in a bank. I do, because I had to go into a bank to sign a piece of paper once that they couldn't do digitally. But other than that, you don't go in. So whether it's your mobile phone, whether it's an online platform on your desktop, that's such a huge part of efficiencies, building that out. And so Royal Bank is right in there. So again, without getting a lot of overlap from what you talked about with TD there, Brandon. So if you're picking one, I would just as happily pick TD as RBC when I'm choosing a bank to represent the financial sector in the world out there.
Maybe we'll get a vote in from the audience. Are you team TD or are you team Royal Bank? Because I totally agree with you there. It's like picking straws between the two. Of the two, though, I would still lean with TD just from personal reasons. I just like TD better, but that's just my own personal experience. There's probably a lot of people that would choose RBC over TD for their own personal experience. But like you said, it's neck and neck. It's basically, maybe I can find a chart of it, but you look at how they perform over long periods of time, and not just TD Royal, but the entire banking sector, very, very similar. So hey, leave a comment down below, but let's dive on into my final stock for today's video.
This is our last opportunity for overlap, Brandon.
I really can't believe this. Like, I cannot believe this. I mean, it's good, and it's good in a sense. I mean,
it is. And when we first came up with this idea, I thought, well, we'll really home in on like a short list. But there are a lot of really good companies out there, and so I found this to be quite a struggle to get it down to 5 only. But we're at 8 now. So your fifth,
the final 2.
pick
well,
is
hey, my final pick is the company Alphabet, ticker GOOG, trading for $2,780. Please tell me you didn't pick Alphabet.
I didn't pick Alphabet, but of course it had to be on my short list. But no, I didn't. No.
Well, we did it. 10 stocks here, and the short list came so close, because when I was looking at the FANG stocks, Facebook, Amazon, Netflix, Google, even Microsoft, which I just thought, I think I know what your last pick is. That just not going to spoil it, but that's my guess. It was very hard to narrow down, and like I said, I'm fully behind your Amazon pick, but Google for me is just the one that stuck out. What I found to be actually quite interesting is I put up an overlay basically to see how these FANG stocks have performed, and Google and Facebook have been the lowest growers of the bunch. Apple has done so well, Netflix done so well, Amazon done so well, and I kind of like that. I don't know if that's a weird thing or not. I don't want to chase the gains that we've already seen. I'm trying to look 20 years out, and don't get me wrong, again, Amazon has so much potential. Apple, I love, but there's something about Google that really stuck out to me. And what I think, I referenced this earlier in the video, Dad. I said this is why I didn't pick Amazon. What I think is going to become more and more important over the coming years is the stigmas behind the companies. Kind of like how people view them. right? And I know that's kind of funny to say because I talk about a company like Tencent, but within the North American market, within like the FANG stocks, you know, you have so many haters that hate Amazon. Like you got all the people that are against Bezos and they don't like Amazon and they're against it. Even Apple has their group of haters, right? You got the Android users and there's so many people that just don't like Apple just because they don't like Apple. Facebook, we don't need to get into that. Like, come on. But Google, like, again, Google to me, this is the one that gets the least amount of hate. You know, I consider it loved by everyone. Of course, there's a bunch of people that won't like Google, especially if you live kind of through the past number of years. But comparing to the others, I think they have the best kind of brand name to them. And that is, I do believe, actually quite important. I think that will be a factor in the years to come. As we mentioned, you know, 20 years from now, who knows where these companies are going to be, right? There's so many possibilities. There's so many areas that we can't even think about right now that they may tap into. And for it to be a company that has the support of just people and the public, I think that's something that we really shouldn't overlook. This is an interesting way of viewing things, but I kind of thought of looking at the digital space kind of like real estate. So when you go on the computer and you browsing the internet or whatnot, you know, there's only a set number of eyes out there in the world and they get directed to certain places. And I think Google owns a lot of this digital real estate. When you think about obviously their search platform, so Google, obviously, YouTube, like they've got these sections of the digital world kind of cornered out. And they're at the point now where they're so established that of course there will always be competitors. You know, you always have, you know, the MySpaces, which at one point were huge. And it's not to say that these companies are, you know, safe from everything, but I think that we're at a tipping point where they've kind of established themselves as these presences, these leaders in the space where the traffic goes, where we spend our time online. And of course, what that all boils down to at the end of the day is that they can generate more advertising dollars on, you know, the YouTube ads and the Google ads and whatnot. It's huge. Aside from just the traffic, we all know Google. I don't think we need to talk about it all too much, but there are so many, you know, areas beyond YouTube and Google, you know, Gmail, Google Maps we use every time we're on vacation without even thinking about it. You mentioned the cloud there, and AWS obviously is huge. Google Cloud, hey, still very respectable. And I think more on a personal level, a personal consumer would use Google Cloud versus AWS, again, two different markets. But on top of that, you have obviously the new and exciting areas like the EVs, partnership with Waymo. You know, they've got their moonshots or their other bets divisions, which who knows what's in store. But what's important to that with me is if you look at their balance sheet, for example, cash position of $135 billion, that cushion allows you to go into these, you know, different areas, right? You can take these other bets. You can try things. You can try the Google Glass, and if it fails, it fails. You can get into the phone space. If it fails, it fails. But you got that cushion, you got that backing, and you take a look at this company's cash flow. It grows year after year. There's just more money they have to put into these areas. So for those kind of reasons, I think it's actually, I would say, almost a safer bet within the technology space, if that's fair to say. I don't know if you'd agree with me there, Dad, but I am team Google. I like the branding behind Google. I got into Google only during the pandemic, maybe slightly before, which was my first time owning the stock. But I see myself owning it for 20 years, and it's been a good performer since. I expect that to continue for the coming years.
Yeah, I do not disagree with you at all. Alphabet was on my short list as well. Again, for all the reasons you just articulated there. And there's a way more depth behind the company than a lot of people. Way more depth. And I haven't looked at the Waymo advances in the last few months, but I think people would be surprised at how advanced those vehicles are. You know, as far as autonomy, the level of autonomy, I think they're right up there at the top. So
agreed.
Lots to come.
Go for it. Yeah, lots to come in the future.
Lots to come. So yeah, definitely a company that was hard not to put on my final five, but I'm glad you picked it. So we have quite a well-rounded portfolio building so far.
Well, hey, finish it off. Let's see what the last one is.
I will finish it off, and you. It's funny because you talked about companies and you're concerned about the stigmas that companies develop, and I think that's so true. Now, the company that I picked for my fifth pick today is almost over the decades a leader in stigma, and the company is Walmart, the world's largest retailer. Now, clearly, it's a retailer. It's bricks and mortar. You know, Walmart is a $418 billion company right now, but they have $560 billion in annual revenue, which is by far the largest. And there's a slide I showed earlier talking about Amazon and how the second largest e-retailer now, or e-commerce in the world is Walmart. And so when you look at the evolution, there's two ways that Walmart could go. They could be, okay, we're stuck in our old ways, and you're going to have to come into the stores forever, which I think people will. People want to go to the stores, but they also are adapting, and that's huge. I think I said at the outset, you have to be able to adapt, especially over a 2-decade time period. So when I look at a portfolio, I think Walmart deserves a spot in there for the reliable income. When you look at those locations that they have 5,300 plus stores in the U.S. alone. And then when you look at their global reach, they have, Mexico is the largest secondary market with about 2,600 stores. And you'll see Central America, United Kingdom, it goes right down about 408 stores in Canada. Very, very large global presence as well. If you look simply at their revenues, now again, this is one of those companies where you're not seeing a huge spike like in a few years. I think the revenue that we can see from Walmart here is just a classic, the way you want a company to build once it's matured. And we're certainly there with Walmart. When I look at just the portfolio as a whole, when I think of, okay, if you're going to buy these companies and you cannot sell them for the next 20 years, I think Walmart is a company that I think it deserves a spot. Certainly not exciting, and I know from a voting perspective, some people might just say, I'm not interested in owning a company that's as old as Walmart, but I don't think they're out. I don't think they're done. I think that their stream is going to continue to grow, and especially, like I say, as they adapt to the new way of doing things, I think it deserves a spot there. So I'm going to stick with Walmart there, and that will sort of wrap up our 10, as it turns out, 10 different companies, 5 each.
Wow.
What I'd like to do as a follow-up video is you and I can just have these discussions in more depth and narrow it down. It would be really, really hard.
That would be so hard, yeah.
It would be hard. But I think the whole exercise here, for those who are still with us, because it'll probably be a pretty long video here, are what are the characteristics, what are the traits that you would want to look at when you're building a portfolio? Now, clearly, you're not limited to 5 companies and you can trade, but you do want to, we liken it to buying shares of a company. So, from when you were little, I would always instill in your head, when you're buying shares of Coca-Cola, you own part of Coca-Cola. You're not just buying a ticker that you can trade in and out. You can, but that's not the theory going in. So, you want to make sure that you have the stability. You want to make sure that you're in a growing sector, growing industry, and times do change. We'll see where we're at. I don't think we're going to do a follow-up in 20 years, though, Brandon. Can we agree on that?
We'll see. But yeah, what a great way to summarize that. We got to think like investors, like an investor, truly investing in a business, not looking at it for the tickers. That's awesome, Dad. Well, thank you guys so much for sticking around. If you stuck around for this entire video, I'm looking at it. We're pushing an hour. Wow. So that's insane. Yeah. But you know what? It flew by because I'm having so much fun. This was also honestly a lot of fun, Dad. I can't believe we didn't have any overlap. But nevertheless, if you are a viewer that is sticking around, let us know down in the comment section below. That is awesome. If you made it all the way through, we appreciate the support. If you found this video helpful and enjoyed it by any way, just drop a big thumbs up because that helps the channel out so much. That's a great way of supporting us too. And if you're new to the channel and watching us for the first time, make sure you subscribe because we post videos like this every single week. But 20-year follow-up, maybe we'll see how that one goes. But
maybe a progress report after 5 years or something. But
something like that. Yeah. But that's awesome. I love the picks, Dad. I hope you liked mine. But
I did. Yeah. No, this was a ton of fun. This was real fun doing this.
Hard video to put together, but fun. I think really good. And
what I would love to see is, if you're still watching, of these 10, what would your portfolio look like? And then you said earlier, Brandon, I mean, what else? There's so many companies that we could have put in here. So, but I'd be curious, of these 10, what 5 would you pick? That'd be awesome to see what the thoughts are on that.
Leave your discussion down in the comment section below. I will remind you guys, just wrapping up, as always, we do have our Investing Academy. So if you are someone that wants courses and training in the stock market, there's a link down below in the description. You can check out all that. We work with Canadians in particular, and we offer online training for beginners, for more advanced investors. We even have a private membership group where you can follow along with our trades and kind of see what we're doing on a day-to-day basis. join the discussion, everything, that's all down below. But I think we'll wrap up there, Dad. As always, I thank you guys so much for watching. Really good to see you. And yeah, I guess I'll see you soon. Well,
Yeah.
on our next video.
Hopefully another video, but I'll probably I'll be down in the Lower Mainland again before too long. So
Before too long. Awesome. Well, thank you guys for watching. Hope you enjoyed, and we'll see you in the next video.